It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. You can reach me at yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C, at yourpersonalbank.com. Or toll-free 866-268-4422, and yes, you will reach me. Today I want to discuss a hunch that I have, an economic one. I think we are turning a corner as a country. It's primarily a Main Street shift versus a Wall Street shift, although there's some benefits to Wall Street also. Scott Bessent, current Treasury Secretary, has stated, it's Main Street's turn, Wall Street will be fine. And the reason I have this hunch that I believe we're starting to turn a corner, it's anecdotal, just having my pulse on the economic and financial situation of people across the country, normal, everyday Americans. I deal with folks that are quite wealthy and those that are not, and everything in between. I have clients literally from 18 to 90 plus, every part of the country, every background, just about every career field you could think of. I've been doing this this is my 27th year now. After doing this for so many years, discussing economic, financial situations with so many people over so much time, you tend to get a feel or a gut feel, and I've always had a fairly good gut intuition about what's going on. Also, there's some numbers that are starting to back this feeling up. Recently, the S&P 500 closed at highest level on record. It's up over 16% since its March 30th bottom. There's been an incredible run. The biggest reason behind it is historically strong earnings. When people are starting to make more money, businesses are starting to produce things. And like I was starting to say before, my hunch is coming from people that are doing things, building stuff, servicing. They're busy. Orders are up. When I'm talking to these business owners, they're backlogged on stuff if they're building stuff. The traders, the investors, although yes, recently have seen quite an upswing, the surge is not coming from trading and asset increase per se and printing of money, although that is still happening. That will likely change with the new Fed chair taking over here soon. But it seems like what's driving this is many call Main Street or the real economy. This is a fundamental shift in our economy. Much of the growth over the past decade or two has been from what I would call artificial inflation of dollars, printing of money, trading, things like that. This is more being driven by real economic growth. Trump's efforts to get other countries and companies to invest in America, build stuff here, we're starting to see the fruits of that. And some companies obviously are benefiting from all of that. A 16% increase in about a month. Is that justified? Probably not. Markets tend to historically overreact, both to the up and the downsides. Job numbers are truly incredible. We're seeing the lowest levels of jobless claims since literally the 1960s. This is good economic news. Wealthy investors are all in on equities. Equity allocation with high net worth individuals right now is about 65% of total assets on average. This is the highest level we've seen in 5 years. Cash holdings by wealthy investors are the lowest levels we've seen since 2018. Risk appetite is through the roof right now, which is creating a wealth gap that's never been wider. In fact, the U.S. private sector financial assets relative to U.S. GDP are a record 6.7 times. What this means is the total value of stocks, bonds, and other financial instruments held by the private sector has never been larger relative to the real economy. The size of financial assets held by the private sector has more than doubled since the 1970s low. When financial assets outpace the economy long term, that increases risk. This is why Berkshire Hathaway just announced its cash balance is up to a record $397 billion, which is a record. The company has also sold $8 billion worth of stocks last quarter, marking its 14th consecutive net quarterly sale. What is Berkshire Hathaway trying to tell us through their actions? What they're saying is this recent run-up, in their opinion, stock values are overpriced. Certainly, if you got to take advantage of this, great. And you really have two options, the way I've seen for most people. You can be passive and just ride the wave up and down, the roller coaster sometimes. And if your risk appetite is high enough for that type of thing that it doesn't stress you out or worry you much, okay, that's fine. When things run up and you're starting to get concerned about a correction, maybe you should take some of the winnings off the table, as I often say. Reduce your risk. Your personal bank is a great way to do that. So are index annuity products. You can continue to get the upside growth, unlimited upside. We have many products with no fees, no cap, unlimited upside, and you can participate in much, if not all or more, of the upside gains. It's the best time in over 40 years for index products. I've been sharing it's the golden age of fixed assets. This isn't hyperbole. It's true. It's a fact. So if high levels of asset values are concerning you somewhat, maybe you should peel some winnings off the table, pull back on your risk. Because the most likely thing that's going to happen is after a really strong run-up, there's going to be a correction. Now, many of my more active investors, as I like to call them, understand this, and they use your personal bank as a tool to help benefit from these strong run-ups and avoid these corrections that are inevitable. Your personal bank allows them to grow their money safely with guarantees, insured, highly liquid, tax-free, earn 6% plus on your money while you're waiting for the correction to occur and re-engage when the next correction happens. And it will happen. It's just a matter of time. It requires paying some attention and some patience, certainly. But I have a number of clients that have been doing this for years and years very, very effectively. If this interests you and you want to become more active, where you peel some of your winnings off the table, take advantage of the next correction, and hopefully ride that one up too, your personal bank could be a great tool for you. Contact me at yourpersonalbank.com. But Berkshire Hathaway's record cash balance, selling stocks now for the 14th consecutive quarter in a row, is a warning. It's a red flag. And as I've often stated, despite this tremendous run-up we've seen in the last month, we saw a real downturn for the most part since the beginning of 2026. We're seeing a lot of volatility, and much of that is being driven by this Iran conflict. Just recently, in one day, due to announcements made by President Trump and Iran, we saw oil prices drop and rise again all in one day by over 10%. 10% swing down and then back up again. This uncertainty creates tremendous volatility. Again, if you have the stomach for it, kudos to you. Human behavior studies show about 80% of human beings don't have that kind of risk appetite. That's just a fact. It's a human behavior statistical fact. And I know when I discuss this with some people, they're even somewhat embarrassed by that when they say they just can't handle the risk, the up and down. They lose sleep at night. It stresses them out. They'll say they should be more durable or resistant to that, but they just can't help it. And eventually many of them just go to cash or sit on the wayside or go way more conservative, which obviously reduces their returns. And that's why index products are so much better fit for that type of person. You can get strong upside gains without downside risk. And that's a common fallacy, that if you want guarantees, you have to give up strong gains. That's just not true. We have products that have averaged 10, 11% plus average annual returns for a decade plus. We even have some that have averaged in the double-digit ranges for 15, 20 years plus. These are real actual numbers, net, in your account. That's what matters, right? Issue of fees often come up. As I stated, we have many products that have no fee, no cap, unlimited upside, sometimes 100% or more of the participation rate, which means you can get the entire gain of the index to the upside. And I get asked the question, how do I get paid? Or what are the fees? Regardless of what a financial person's title is, I'm sure you can appreciate that if they recommend a financial tool, they typically get paid by the company. It's usually in the form of a commission. That's how I get paid. And if we're not charging money under management fees, for example, say 1%, in a decade, you've got 10% more money without compounding. This is something that my clients tend to really prefer. Part of the reason why my 27th year successfully doing this as an agency, thousands of clients, extremely high retention rate. Because once you are able to grow your money and get solid double-digit returns, we had folks making over 20% this past year on their index products. And the difference between index products with my clients versus somebody invested directly in the market is this. If they get that 20% return, for example, plus in a year, and the market corrects after that, they get to keep it. Not only do they guarantee the principal, the downside, but when you lock in a gain, that becomes your new principal. So literally each and every year, your account value stays the same or goes up. It never goes down. I know index products out there have gotten somewhat of a bad rap in terms of low returns or fees sometimes. It's not the product's fault. That's what I want you to understand. You're in the wrong indexes. You're in poor performing indexes or ones with fees that are causing your returns to not be very good. I run into this all the time. Literally every week, I meet with somebody who shows me an index product they've had for a number of years, and their average returns are in the 3 to 5% range typically. Where I'm doing reviews with my clients, I can't think of a single client I've reviewed in the past couple of years that received less than 7% returns, and many of them double digits. We had several clients get 23-something% last year alone, and they get to keep it because those gains are now locked in, and they get to move forward from there, not have to recover, lose value, and retrace those steps. If this interests you, contact me at yourpersonalbank.com for more information. Stay tuned in the next segment. I'm going to discuss some other economic issues, including real estate and debt.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. And yes, you will reach me. So although the stock market has seen tremendous rebound in the past month or so, due to many of these companies posting stellar earnings reports, jobless numbers are down. These are all good signs and good things for the economy. We're not out of the woods yet. And this is where I believe some of the volatility will continue, as we have seen since much of this year. And one of the reasons that we're not out of the woods yet happens to be where Americans are currently priced out of homes. Depending on the state, the percentage of Americans who cannot afford the average median home in their state ranges from a low of 59% to a high of 83%. So basically, 60 to 80% of Americans cannot afford the average home today. Median home prices vary in different parts of the country, but the fact remains that the vast majority of Americans just simply can't afford it. Particularly affects younger people. If younger people can't get started, start a family, and those types of things because they just can't afford a home, we're going to see some real negative consequences of this long term until this problem gets fixed. And this isn't an easy one to fix, frankly, because on top of housing prices still remaining too high for the vast majority of Americans, the personal savings rate to some of the lowest levels we've seen since the 2008 financial crisis. Inflation numbers have been declining, but the problem still exists is that even if you have a 2.5% or so inflation rate, it doesn't mean prices are going down. They're still going up. They're just going up slower than they were before when we had 6, 7, or even 9% inflation readings a few years ago. And it's the cumulative total of approximately 30 to even 50% increases on basic household goods like food, housing, clothing, fuel. That cumulative increase is what's squeezing households' buying power and why we're seeing such a low savings rate for a big percentage of Americans. This is a challenge for a growing economy. Now, the low jobs numbers, as I stated earlier, is helpful in offsetting that and could eventually help alleviate that problem some. So again, there's cause for concern and cause for hope. The U.S. auto loan crisis is also still accelerating. The average amount that a car borrower is underwater is now over $7,000. Part of the reason, overall, about 30% of car buyers who traded in a vehicle past quarter had negative equity. Part of the problem was pandemic-era vehicles jumped in price. Many bought at what now was peak prices, and those have lost value faster than borrowers can pay down the loans. And this article I find of particular interest. The title states that the U.S. bond market is in serious trouble. And the reason they're saying that is because bond yield rates, or the interest rates that bonds are paying, have risen. They point out that the 10-year Treasury is now up to about 4.5%. The 30-year Treasury has hit 5% recently. Now, the thing about bonds is, depending on what side of the equation you are, it's either a good or a bad thing. Are you a buyer of bonds because you want the interest rates it's paying? Well, in that case, the higher interest rates happens to be a good thing. Conversely, if you own bonds previous years that were paying a very low interest rate, now that same bond is paying a much higher interest rate, your old bond is worth less. You go back 3 or 4 years, 30-year Treasuries were selling for less than 2%. If you own one of those and it's only paying you about 2% interest, versus you can purchase one today and it's paying 5% interest, more than double the return on that bond. Obviously, the bond that's paying 2% is worth a lot less than the bond that's paying 5%. Now, why this is the golden era of fixed assets and why insurance companies and banks and those industries are doing so well is about 70 to 80% of a typical insurance company's portfolio, what they own, are bonds, are paying double to 2.5 times more than they were 3 or 4 years ago. The profits on their portfolios have more than doubled on average. The insurance industry and the banking industry have not seen these types of returns since literally the 1970s. This is why it's the golden age. This is why it's been the best it's been in over 40 years. And this is why the returns on these index products, your personal bank, dividends, all of these things, we're seeing record numbers, record levels we haven't seen since literally the 1970s. It wasn't that long ago you couldn't find a CD that would pay even 1%. Not many people were interested in investing in that type of financial tool. Today you can find 4% easily. Well, right there, that's more than quadruple the return to the CD investment holder. Now, I'm not necessarily saying CDs have the best returns in the fixed asset world, but you can see the difference. You can see where an increase in the long-term bond yields that's more than doubled has allowed the banking industry to offer CDs that have more than quadrupled in their rate of returns. The same thing applies with insurance companies. The rate of returns on their index products versus what was offered 3-4 years ago or longer have literally, in most cases, tripled, if not even quadrupled from what they were before. This is why if you have an index annuity product or an IUL, a dividend-paying whole life policy, you really should look at the new products because they're almost certainly paying double, triple, sometimes even quadruple more than what you have been getting previously. And I'll be sharing this in probably the next segment. A client that I met with recently who has had a index annuity product for the past 9 years. They've averaged about 3% returns, very poor. They have a index cap on one of their indexes, their primary index they're invested in, at 4.5% cap, which means they can never make more than 4.5% a year. I showed them a new product that would pay them a 20% bonus and a 12% cap on the exact same index, and that wasn't the best option available. So even if we took the same index that they already had and rolled them over, transferred them 1035, a tax-free exchange, so no taxes involved, we could get them a 20% bonus plus nearly quadruple their upside potential gains on the exact same index, and there were other indexes that offered even better. No fee, unlimited caps, unlimited upside. Historically, they've averaged 9, 10, 11% average annual returns over the past decade plus. And the reason why the 20% bonus was so important is they had a penalty to get out of the existing product, the poor performing index product. Well, their penalty was nowhere near 20%. It was less than half that, in fact. They were significantly ahead with the bonus over the penalty, and now the potential to triple to quadruple the returns they've been getting, assuming the next decade looks like the past decade. And I think that's a pretty good bet. Although we are in a volatile period, a transition period, we have uncertainty with the Iran situation, the Middle East, lots of volatility. Our economy is transitioning from, as Scott Bessent, Treasury Secretary of State, has stated, from a Wall Street to a Main Street focused economy. There's going to be hiccups. There's going to be bumps. There's going to be uncertainty. But in the long run, I do believe we're starting to see the beginnings of a good, strong, growing real economy for people who make stuff, build stuff, provide services, unlike what we've seen probably for the past 3 or 4 decades even. It's been so long ago, many of us have forgotten what that is really like. And we're going to have to go back to what things were like in the 80s or 90s even. Another question I get often is about the U.S. dollar and the world currency reserve status. Here's another reason why I'm seeing reasons for optimism. Offshore U.S. dollar deposits held in banks outside of the U.S. are up to a record of $14.5 trillion, which is an all-time record. International banks hold more U.S. dollars than at any time in history. Offshore U.S. dollars are now equivalent to about 43% of U.S. domestic bank deposits, and no other currency is anywhere close to this level. Global demand for the U.S. dollar is the highest it's ever been. So the fears of the U.S. dollar losing its world reserve currency status have been greatly exaggerated so far. And there's some new developments that are likely to cause this to continue for the long term. I'll share those in the next segment, so stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ference, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. People are often surprised by that. But if you reach out to me, call, email, go to my website, you have a question, you want to inquire about something, you like to discuss your financial situation, or just explore a really strong diversification strategy, reach out to me. You will find it quite educational. I'm almost certain of that. Most people find it very beneficial. It's worth looking into. Now, I mentioned in the last segment that offshore U.S. dollar deposits have never been higher. Global demand for the U.S. dollar has also never been higher. This bodes well for the U.S. dollars as a world reserve currency. There's some other things that are happening that will likely lead to the dollar's dominance as a world reserve currency in the future. The dollar's strength as a world reserve currency is based on the petrodollar. World markets currently are all priced in U.S. dollars. World oil markets currently are priced in U.S. dollars. There's no effort to change that. The Iran conflict and shutting down of the Strait of Hormuz has caused many companies and countries to switch their purchase of oil from the Middle East to the United States, further increasing the dominance of the U.S. dollar, the U.S. petrodollar. But it's even going beyond that. UAE recently left OPEC. This is massive news after 58 years of being a member. Part of the reason was they are sitting on $93 trillion of spare oil capacity, and it was never allowed to pump because Saudi-driven OPEC quotas kept getting in the way. They want to be able to sell their oil and not be restricted. Can't say I blame them. But to make matters even stronger for the U.S. dollar, they opened a sovereign dollar swap line with the U.S. Treasury. A lot of people don't understand, in the media even, what these sovereign dollar swap lines are about. What the Treasury does is they roll out a direct dollar swap line with a country. They did it last year with Argentina, now with United Arab Emirates. This is probably one of the biggest shifts in global finance since Nixon took us off the gold standard in 1971. And in a positive way, likely leads to a huge shift in the U.S. dollar dominance in global finance. See, instead of the International Monetary Fund or World Banks or these other organizations dominating world finance, the Trump administration has circumvented the middleman. These swap lines are not bailouts or foreign aid. The Fed provides dollars to a foreign central bank, and it takes their collateral, it takes their currency as collateral, and reverses it later at the same rate. There's little or no risk. It's purely leverage. And now those countries can then purchase and use more U.S. dollars. It puts the United States in the driver's seat, even more so than it was previously. The International Monetary Fund will likely continue to exist. It just won't control or dominate. The United States will. It cuts the middleman. There are benefits to being part of the club and access to the U.S. dollar with these credit swaps. Membership has privileges. Exclusion has consequences. This greatly weakens the BRICS currency, as it puts the United States in charge of the global financial situation and likely ensures long-term U.S. dollar dominance as the world's reserve currency. Clearly, one of the benefits many people have attributed to precious metals was the weakening of the U.S. dollar as a world reserve currency and the BRICS gaining momentum, that's pretty much a dead horse now. So if you're going to own precious metals, I would not recommend that being one of the reasons for doing so. There's some other reasons to do so, I understand, but that probably isn't one of them going forward. This is one of the reasons why I'm even more bullish or positive about dollar-denominated assets going forward, particularly in the medium and long term. I've stated this many times before. I believe we have short-term volatility as our economy transitions, as we transition from a more of a Wall Street-focused economy to a Main Street-focused economy. These are all the efforts that are going on as we currently speak. The fact that President Trump has secured $19 trillion of agreements from around the world to invest in the United States. What I want you to understand, folks, is even if only half of those actually come to fruition, $10 trillion invested into our country over the next few years will have a massive impact in a positive way. More things will be made here. There will be more jobs. Part of the reason why I believe we're seeing unemployment numbers drop, income will start to go up. We have fewer people in the country today than we did a year ago. Deportations and those types of things are continuing. They actually have not slowed down. If you look at the raw numbers, ICE is actually deporting more people than it was last year. They have more agents. They're just doing it quieter, which is more politically palatable. One of the folks I met with this past week was quite interesting. Very intelligent gentleman. It's a scientist, in fact. Had a number of different investments in various places. Very typical to what I see on a regular basis. Heard the show, reached out to me, felt like he needed to consider some diversification. He liked the idea of index products with the unlimited upside, no downside risk. With the recent run-up of the S&P 500 hitting new all-time highs, a lot of people look at that as a good time to peel off some winnings before we see the next correction. And an index product allows you to lock that in. Don't participate in the downsides or the corrections, which is great. And when you lock in your gains, you keep moving forward. Oftentimes, when I look at portfolios like this gentleman's over the past 5-10 years or so, his average returns, looking at the statements, were about 6%, mostly in equities, so fairly aggressively invested. There's a lot of reasons behind it. Some involves fees, some of it involves the products he's invested in. But when you see these S&P returns like 20%, please understand, most people are not invested in those types of assets, and they have a diversified portfolio, so their actual returns, in the vast majority of cases, at least on statements I look at on a regular basis, are far less. And to be fair, this gentleman's returns over the last 5 years or so were higher than what I see most of the time. This isn't guesswork. We're looking at actual statements. How much did you start with and how much do you have now divided by how many years? It's really not that complicated. I pointed out to him the index products that we have available over that same time frame have averaged about double that. Showed him a couple of different indexes that averaged over 11% over the last 5-10 years. I showed him some others he reached back out to me for some longer term numbers, and we have products that have averaged 7 to 11% over the last 15-20 years. These are actual returns, net, in your account. Because that's what matters. How much is your account start with, and how much is in it now, right? Or how much you have now, and how much will you have in 5 years or 10 years from now, or whatever. As we discussed, potentially rolling over some of these assets. Some assets he wanted to keep where they were, which was perfectly fine. I agreed. I felt like he had valid reasons for doing so, but some others he was not so happy with. Again, the ones that have given him about a 6% return over the past 5 years. The ability to grow the money, most likely roughly double, again, based on assuming the next decade looks like the past decade, his returns will likely roughly double. And if the next decade is not as strong as the past decade, well, he won't lose on those downturns either, will he? And this is why I shared with him and showed him some examples where in the vast majority of the cases, the folks that were invested in the index, good index products, strong upside gains, little or no fees, unlimited caps, unlimited upside, strong participation rates, often had more money in their accounts than if they had stayed invested directly in the markets. And the reason was quite simple. They didn't participate in the downturns. If you have a downturn and then you have to recover from that, whatever time frame that recovery is, whether it's a year, 2, 5 years, or whatever, we've seen some that have taken 10 years or more in this century. Whatever that downturn and recovery period time is, you have to understand, did you make any return during that time frame? The answer is no. You're just retracing old ground. You're getting back to where you were. An index product allows you to not participate in that downturn. And then when the markets do recover, the indexes do recover, you get to go up from the higher point. So if an index in the markets drops 20% in a year, for example, and you don't participate, you have 20% more money, don't you? And then if it goes up from there, you're going up with 20% more money in your account. And that is why, in most cases, with clients I deal with, looking at statements, real statements, not estimates, not hunches, real statements, they often have more money, again, because they didn't participate in the downsides. If you want more information on this, contact me at yourpersonalbank.com. And I would encourage you to stay tuned on the last segment because I got another client here that is a situation I often run into with folks who do have index annuity products and the reasons why they're not performing like they should and how we can fix it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. So this last client I want to discuss today that I met this past week was a interesting and common situation I run into. And this was a gentleman who had an index annuity product he had purchased 9 years ago. His average annual return on this particular product was about 3%. He had several indexes available in this product. His best one had an annual cap rate of 4.5%, which means the maximum he could earn in a year would be 4.5%. I run into this all the time, nearly every week. He wasn't happy with his returns. He heard me discussing clients getting strong double-digit returns even for the past decade. No fees, no caps, unlimited upside, strong participation rates. And as I shared with him, as I often do, and this is a common misconception, that if you want guarantees, you have to give up strong returns. That is not true. It's a fallacy. Index products have gotten somewhat of a bad rap because many of them have poor returns. It's not the product. You're in the wrong indexes. Why are you in poor performing indexes? The most likely reason, sadly, is you and the agent you worked with just didn't know any better. Now, why would they not know any better? They didn't have the information they needed able to steer you or guide you towards the indexes that tend to perform stronger. Most of the time, it's a lack of knowledge and a lack of information and a lack of the proprietary information like index performance reports that very, very few advisors or agents have access to. Also, the vast majority of financial people are tied to a certain organization, so they're not independent, which means they're not able to offer essentially every product that is available. They may or may not be able to offer you the best thing that's available. Now, they may think it's the best thing available, and partly that's because that's all they know. It may be the best thing they have available of their repertoire of products, but it's not necessarily the best product available in the industry across the country. There's a difference, a big difference in most cases. And if you look at these index performance reports, which if you contact me at yourpersonalbank.com, schedule a time, I will show you. These get updated monthly, and there are literally hundreds of indexes out there from Goldman Sachs, Morgan Stanley, S&P, NASDAQ, you name it. Performance reports share the 1, 5, 10-year results of what these indexes have actually done. Again, it's not estimates, it's not projections, it's actual returns. And what you will find when you look at this index performance report is you will quickly see that about 80% of the indexes that exist and are offered out there are poor performers. What I mean by that is average less than 7% annually over the past decade. Many of them only offer 3, 4, 5%. That tends to be the norm. That's the old 80-20 rule, the 80% rule. Just don't do very well. So statistically, if you have an index product, IUL, index annuity, the indexes that you're invested in, there's an 80% chance you're in an 80% product or a poor performer. There's an 80% chance you're in an 80% index or a poor performer. About 20% stand out. Many have strong double-digit, 10, 11% even average annual returns over the past decade plus, some 15, 20 years even. And we've seen returns on some indexes as much as 37% just in 1 year, a couple of years ago. Now, we had one index last year that went up 67% in 1 year. Happened to be a gold index. I get asked that question often too. Yes, we have a gold index annuity product that returned 67% last year. Now, is it likely to do that again this next year? Probably not. That's most likely an outlier. Would I recommend jumping into that one at this point? Again, probably not, unless you had some really, really good reasons to do so. Now, the beauty of this is the folks that were in that index a year or so ago received that 67% return in 1 year, and now it's locked in, that gain. So if you had $100,000 invested in there, you now have $167,000 in 1 year, and if gold goes down next year, you get to keep the $167,000 in the gold index annuity. And that's true for any index you're in. That's the strength and the power of these products. Well, the other problem I run into, typically with folks who already have an index annuity product, there's an early surrender charge to get out of it. And this is what often causes people to not consider looking at an alternative because they feel like, well, although I'm not getting very good returns, it'll cost me too much to get out. Again, this is another fallacy or myth I want to dispel. We have products with strong index returns, most cases double, even triple the returns you've been getting, say over the past decade versus what you did get. plus upwards of 20% or more signing bonuses up front. I'm not aware of any index annuity product with a 20% penalty. Therefore, even if you had a relatively high penalty, let's say it was as high as even 10%, that would be pretty extraordinarily high, and you had a 20% bonus, signing bonus, you could see really quickly where you're well ahead of the ball game right out the gate. Plus, in being in stronger indexes, likely see double, even triple returns going forward. I was finishing up the paperwork for a client I worked with the last couple of weeks. They're transferring the funds. He's getting a 20% bonus on these products. He had a 6% penalty to get out. His bonus was nearly $100,000 combined, where his penalty was only about $30,000. So he's up $70,000 day one on his account values, and the indexes over the past decade have averaged about 2.5 times the returns of what he's been receiving. Well, that's a pretty good bet. And I understand that past performance is no guarantee of future results. We've all heard that. But if we look at two different indexes, and let's say we're looking at one that has never, ever in the past decade, ever performed more than 5% in any given year. There's a lot of them out there like that, folks. I want you to understand that. In fact, that's the norm. That's not the exception. That's actually the norm, which is why index products have gotten somewhat of a bad rap in terms of poor performance. But then we look at other indexes that have averaged 8, 9, 10, even 11% average annual returns over the past decade, 15, 20 years even. Well, what are the odds of the strong performer doing better next year than the poor performer? What are the odds of the one that's never done more than 5 suddenly bust out a 10% return in 1 year? It could happen, but the odds are quite low. Statistical probability to it, you probably have an 80, 90% chance or better of the strong performing index outperforming the poor performing index. You want to put the odds in your favor. It's quite simple. And what if the markets continue to go up and go strong? Well, great. If you're in a index IUL or index annuity product, no or very low fees, no cap, unlimited upside, well, guess what? You're going to get that strong return. I have stated earlier, I have seen 37% return in 1 year on indexes credited into people's accounts. That's not the norm, understand, but I just want you to understand what has and does happen. And that's where that fallacy of if you want guarantees, you need to give up strong returns is false. You can still obtain strong gains on good market years or good indexed years with a strong index. But conversely, if the market doesn't perform so well or even has a correction, well, now you're also way ahead because you don't lose. The principal is guaranteed. And then secondly, on top of that, when it does recover after that correction, you have more money in your account. You're recovering from the higher point, not the lower point, which means you don't have to retrace the losses, which means you don't have to give up that lost time, however long it takes, for that recovery to get back to where it was. What if it takes a year or 2 or 5 or even 10 or 15 we've seen? Remember the lost decade in the early 2000s. It was called that because many people who had invested in 2000 after the dot-com crash took a decade to get back to where they were. Will that happen again? I certainly hope not, for everyone's sake. But is it in the realm of possibility? Certainly, absolutely. We have to be aware of that. I would strongly encourage anyone who's seen some tremendous benefits, run-ups in the last month or so. My gosh, 16% increase in the S&P 500 in roughly 1 month. That's incredible. Is that sustainable? Probably not. Will we see a correction or a breather or something? Most likely. We're seeing oil prices shift 10% up and down, even in a day, just on news from the Middle East. Until these things are settled, regardless, even if it is settled, when you're at extreme levels, that volatility and risk is enhanced. This is why Berkshire Hathaway is sitting on a record level of cash, the highest they've ever been. because they recognize that the risk is elevated. And this is the time to pull back on your risk. The chips have built up. You've done well. That's awesome. Take some winnings off the table. That's my recommendation. Let the rest ride. See if it'll continue. By the way, if you put it in the index product, you will also still get upside gains going forward if the run continues. When that point occurs, when the correction occurs, you now don't participate. And lastly, some of these index products even have an interesting feature that you can lock in the gains at any, not just at the end of each year, but at any point you want to. So we're seeing some of our folks do that, where we've seen this tremendous run up in this past month, and maybe they're halfway through their year or 3/4 of the way, and they feeling like, hey, I'd like to lock in or put in a range where if it goes below this, I'm out, and I lock that gain in that I've just received. You don't have to ride the roller coaster up and back down again if you don't want to. You can ride the roller coaster up and get most, if not all, of the benefits you've been getting without the downside risk. And when you understand, you put those two pieces together, in my experience with my clients long term, most of them actually have more money. And isn't that what it's all about? It's about how much money is in your account when everything's said and done. Contact me at yourpersonalbank.com for more information. Stay tuned next week to the Your Personal Bank Show for more great info. And as long as it's on our money, in God we trust. Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.
Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice.
When people contact me, they often ask, what exactly do you do? And yes, if you contact me, I, Ference, host of the Your Personal Bank Show, will respond, not an assistant. I help people increase their returns, reduce taxes, increase positive cash flow, and reduce market risk. I accomplish your goals using various financial tools, including Your Personal Bank. If you have questions or would like to discuss your situation, contact Ference at 866-268-4422 or yourpersonalbank.com. This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.